All right, Matt, we're live. Thanks for hopping on. I'm excited to learn more and get to know you better.
Thanks for having me. Really excited to be here.
Yeah. Let's kick it off. You've been working on Origin protocol for a long time. You have under Origin, there's multiple different projects or products that you're spinning off of. How do you think about the current structure of the organization today? Is there I know that's changed slightly over time or significantly. Where are things today in terms of the focus of the people internally?
Yeah, that's a really great question. So we've been around for a while, as you said. So we started in 2017, and originally the idea was to enable all different types of commerce on chain. But what we realized, pretty quickly is that at the time, at least, the market was still quite nascent. There weren't that many people in Web3, and we built a bunch of products that people weren't really using. And as a result, we decided to do some small and larger product pivots. And throughout the years, what ended up happening is we ended up building two products that have actually found traction and are growing well right now. One on the NFT side and one on the DeFi side. On the NFT side, we have a product called Origin Story. It's a technology platform that enables creators to very easily launch their own NFT sales. The broader ambitions are to create these ecosystem tools so that people aren't just running sales, but they're also engaging with their collectors. They're also facilitating secondary transaction volume. They're developing deep community, all by using our technology. And Origin Story thus far has been quite successful in launching, some of the, most interesting NFT launches in the last year. One of the first ones we did was an $11.7 million sale with Blau, the musician and producer. And at the time, it actually set records for the largest NFT sale of all time for just about a month or so before people came in with a $69 million sale, and the rest is history. But we worked with all different types of celebrities, influencers, brands, and established NFT artists. We're really making a push into new verticals right now. Whether that's GameFi or Metaverse Land, or the kind of traditional PFP avatar collections. So the technology is meant to be pretty flexible to meet different creators' needs. And so that's like one business line. The other business line is in the DeFi space, and what you'll notice right away is that they're not entirely related, right? There are these two products that kind of were both experiments that started taking off. The second product is OUSD, Origin Dollar. This is a way to bring DeFi to the masses, to make DeFi much simpler for folks that are not super sophisticated. And the idea is you can buy Origin Dollar. It's a stable coin. And so let's say you have 1 million units of OUSD sitting in your own custody wallet, let's say on your Nano or on your MetaMask, and it'll just start accruing yield for you. So in the background, the smart contracts are earning yield on different DeFi platforms, whether it's like Convex or Aave or Compound, and that yield is being accrued to the protocol. And OUSD is very unique in that you don't really need to do anything. So at the end of the year, you might have 1.2 million OUSD rather than 1 million. It's a rebasing token that automatically generates that yield and then delivers it to everyone's wallets. So again, it makes it way easier to get involved in DeFi. You don't have to stake and unstake. You don't have to move your liquidity to different pools. You don't have to be constantly monitoring. The idea is the protocol does all this work for you. And so that product is also gaining a lot of traction right now. We're talking to a lot of institutions, whether they're family offices or these other TradFi institutions that are looking to get the yields of DeFi without the hassle and the risk. So two distinct business lines. It's actually one of the most unique periods of company building right now because we ended up with these two different business lines that are both doing well and are a bit unrelated. So the decision was made just a couple months ago that, hey, we should actually have these be separate protocols with separate tokens, separate dedicated business teams so that they can actually thrive. Because also the communities that are using and supporting these products are different. The overlap isn't very, very high. And so we're in the process of launching a new governance and value accrual token for the OUSD side. The new token will be called OGV. And then our original token, OGN, will be the value accrual for the NFT business Origin Story. And the idea now is two tokens that have very clear utility, very clear narratives, are very, very easy to understand. to the community and token purchasers and users, and then ensuing to businesses that are both thriving, and how do we actually use the tokens to incentivize behavior and then product growth, and then conversely, or I guess like not conversely, but turning the flywheel, that product traction should be then driving token value. So we're in the middle of this process right now. It's super, super interesting. It's almost like a public company doing a spinoff, but we're in crypto land. And so we've seen this happen a few times with other projects, but we're still one of the earliest ones to do this. So it's going to be a fascinating experience, but we're very, very bullish on both the tokens and also the products that they represent.
That's cool. It's pretty interesting to be working on sort of multiple things that are growing. I started a crypto project or company in 2017, and early days, it's like it was all about cash flow, like getting something that generates revenue and is growing and is useful, as opposed to just pure speculation. Which one of these did you start first?
So it's kind of funny, right? The original version of the NFT platform was a decentralized storefront. And so that technically came earlier. Then OUSD came earlier, but we then pivoted the decentralized storefront to focus on NFTs, right? So I would say the products in their current forms, OUSD came earlier, but then this desire to enable on-chain commerce probably was even earlier before that.
Yeah. And I know some of this might still be up in the air, but do you think the higher level structure of the company runs multiple projects? So they're launching another one. There'll be a third, fourth, fifth in the future, kind of a like alphabet structure to Google, or do you view it as like, hey, we're going to double down on NFTs and try to build that out?
I think the reality is both in an ideal world, but it's a matter of prioritization and sequencing. So I don't necessarily think that we would have necessarily wanted to have two separate products with a very small team and one community. But here's where we're at, right? And they're both doing well, and we feel extremely blessed. Like our team is still only like 25 people, right? And so we're
really
very, very lean. Yeah, super lean. But we have two like live, functioning, growing business lines. And so step one is to make sure that both of these existing businesses can thrive and can be taken to the new levels, right? So on the OUSD side, we want to 10x, then 100x circulating supply. On the NFT side, we want to build a bunch of new features that empower our creators and also the buyers. And then from there, really stake our put our stake in the ground as to like, hey, like we're going to be able to serve all different types of creators across different formats, and we make it super, super easy. And similarly, we want to like 10x, 100x that business as well. But to your earlier point, I think that Web3, crypto, blockchain, these things are not going away, and they're only going to accelerate in terms of user adoption over the next 5 years, 10 years. And I plan to work on Origin ideally for the rest of my life, right? And so what does that mean for the next 40 years of work? I think that this Web3 movement is going to be the next decade or 2 decades, right? And so I want to be very, very actively involved in that. Our team is going to be very actively involved in that. And so I do think there are longer term aspirations of building something like a Meta or a Alphabet. It's going to take time. I don't want to rush into it and spread ourselves too thin, especially with a very small team size. But assuming we're able to achieve the milestones and the growth that we expect from our Origin Story product and the Origin Dollar product in the next 6 months, 12 months, I definitely think it's not out of the realm of consideration that there would be a third product or a fourth product or a fifth product at some time. We've seen this happen with some of our peers in the space. So a good example is Gnosis. They launched even a little bit earlier than we did a very substantial fundraise, had a bunch of capital in the bank, but their initial product also did not really get much traction. So they had to pivot a couple times. And since then, they've launched Gnosis Safe. They've launched CowSwap, both products with traction, and they're now working on Gnosis Chain. And so they have a little bit of that same model, right? There's the parent Gnosis brand, but there's three different tokens, three separate teams that are well funded and operating independently, but still kind of have a shared community and almost like a shared I hesitate to use the word board because it's not really a board, but the founders are involved in all those projects. And I do think that that's going to be a model that we potentially see more of as kind of like that last cycle's winners start thinking about, what else to build in this upcoming cycle.
Mm. Yeah, and you kind of see that with other companies as well, like crypto.com or blockchain.
Yeah,
they seem to say like, and my suspicion is that it's partially about trust, because when people get into crypto, building trust is a really hard part of it, naturally, because innately you're just dealing with money in a new way. And so once you build trust, then it's like, well, we can layer on new products much easier than someone can spin up a new product and try to build trust. So it's almost like the underlying subtle currency is trust that you build through the brand, and then spinning up new products are just under the umbrella.
I think it's trust, like you said, but it's also like related to that trust is like an established community, right? And crypto is all about, I would say, two things. It's about technology and it's about community. And how do you put the two together so that everyone wins, right? And that last piece is around crypto economic incentives. And I think that having established community of people that care about what you're doing is an excellent initial seed for you to market your new products, right? And in crypto, it's a little bit different than Web2 because it's not just a new product, it's also new tokens and new opportunities for the community to benefit and to, frankly, make investment returns, right? And so having demonstrated that ability to build product and to make token holders happy once or twice, you end up having a lot more confidence both internally and also having that confidence externally with that trust with the community. And I think the same thing applies to like partnerships and integrations, like getting your tokens listed on centralized exchanges, working with other leaders in the space. There's something to be said about having been there early enough and having survived crypto winter and having built stuff that people use.
Yeah, so true. Did you raise money? You guys raised, correct me if I'm wrong, I have 38 million. Was that through traditional VC with a traditional C Corp structure to it, or was it through token sales?
So we do have a Delaware C Corp, but that's we didn't sell equity in the company. That is actually not where the majority of assets or IP are located. So Origin has what's known as Origin Protocol Institute. It's a offshore Cayman entity, and that's the most important entity amongst several in the corporate structure. But yeah, we raised $38 million. At that time, we used what were called SAFs, right? But essentially, it's a promise for future tokens. And we successfully delivered those tokens and built out, I guess, not the same platform that we sought to build out in the beginning, but built out, alternatives that are working very well. And so, it's a different model, right? It's very different than selling equity and having venture investors. It's selling tokens and delivering either governance privileges or value accrual mechanisms to those token holders. That being said, we do work with VCs. Like there were traditional venture capitalists as well as crypto funds that invested in our private sales. So it wasn't like, hey, just release this to the community. And I actually think that the right model is a little bit of both, right? Like how do you get some initial seed investing with reputable investors that can actually add value, whether that's through advising or strategic partnerships or introductions. But then ultimately you want to have enough of the pie that you can deliver to the end users, the community members, the participants are going to be adding value to your protocol and your platform. And so it's important to make sure that that pie is allocated for properly.
So when you raise, you have the Cayman Island Institute. Is the contracts with investors enforceable in the U.S. or is it only? I just want to learn more about the structure of setting up a Cayman company? Is that something you have to have an office down there? Is it an online registration to get up and running with that?
So we have, so we actually have the U.S. entity and then multiple Cayman entities actually. It's a reasonably complex arrangement. And the reason is like we wanted to make sure that from a regulatory perspective, we're very, very compliant. For example, when we sold tokens, we didn't have to make this decision, but we limited it to accredited investors until the platform was ready and token utility could be demonstrated. There is, we have representatives in Cayman right now, and there's no there is an office for those representatives, but it's not like there is a room full of 50 people working.
Yeah.
Right?
Yeah. And so investors come in, they say, hey, I'll give you money now. And then in exchange for that, you give me the right to own the tokens. Is it when they're minted, or what was the schedule of return or ownership transfer that you guys decided on?
So the way we did it was there was a lockup schedule after initial token launch, and then there would be quarterly unlocks for 2 years roughly. There are all different types of lockup schedules that people will use these days. We felt like it was very important to have both investors and team unlock gradually, so that on the one hand, we had enough time to get the word about what we're doing and build that product traction. On the other hand, we wanted to make sure people were incentivized for the long term, right? So, we're one of the companies where all our team members are on 4-year vesting schedules. People that perform well get refresher grants, et cetera. And so that part we've borrowed from Web 2. A lot of other protocols we've seen, have kind of ridiculous, everyone's vested out in a year or 18 months. And we don't think that aligns incentives very well. That makes for short-term behavior. And we want to be for the long term, right? These days, it seems like the most popular structure is to do a safe with a token warrant on top. And that allows companies to raise with a very lightweight set of documents that investors are familiar with, right? Safes are pretty ubiquitous at this point, and token warrants are also very light. And that allows entrepreneurs to raise from investors very quickly, but then also affords them the flexibility to launch a token, right? And very rarely are you in a position where you're ready to launch a token right away, because you have to figure out a lot of stuff. You have to figure out the potential offshore entities. You have to refine your tokenomics, and also just have some time to build out that core product. So the safe plus token warrants seems to be the de facto standard these days.
Yeah. So when it's a safe with a token warrant, the warrant is the right to invest. So the money goes into the account of the company, which would be, I imagine you're sending it to a U.S. bank account. And then that safe is the ownership declaration of the shares in the future. So the warrant on top of the safe would be, how does that work? That would be the claim of the tokens.
So a safe is, as you probably know, is a document that allows for conversion to equity. And so typically when a company issues safes to investors, it's invest a certain amount of money, and then there's some sort of conversion ratio, usually dictated by a valuation cap, that determines how many shares are converted to equity when there's an equity conversion event. And that might be a Series A, or that might be an acquisition, or in rare cases an IPO. But the token warrant on top of that is saying, okay, rather than that safe converting to equity and it's stopping there, how does that equity convert to tokens? And how does the equity of the company basically map to the token allocation of the platform? And so in some cases, it may be a one-to-one conversion, right? So let's say you have 1 point of equity that converts to 1% of the network. But in other cases, what we've seen is companies want to leave tokens on the table for the broader community, right? And so you might say that, hey, this is you're doing a fundraise for Mike's Foundation, and you're putting a $10 million raise up, and that $10 million will potentially convert to let's say half of Mike's company. But when you're launching the network, the token network, maybe the company only has half of that allocation. The other half is going to go to the community, right, or new investors or liquidity providers, et cetera. And so then that's like a 2-to-1 conversion, right? So your 1 point of the company is actually 0.5% of the token network.
Right. That makes a lot of sense. When you guys were making these decisions on how to structure everything, I know from my experience, this is like, it's not the thing you think about until it's the thing you think about, and then it's all you think about when you're raising and trying to structure like tokenomics. Did you default to, how did you learn? Is there a site or a company or podcast or person or book or something that you, or was it just osmosis through listening on Twitter?
Yeah. When we were going through it, it was purely osmosis, and like we basically figured out what comps were that other projects were doing, like what percentage to go to the community, how much you want to sell, what were like typical valuations. And I think that's definitely one place to start, because you want to know what you're worth in the market, right? And you also want to know what the market will bear in terms of valuation and how much dilution should you take as a company. So those comps are good, but I do wish that we probably spent more time thinking through all the ramifications, right? So Josh, my co-founder, and I often talk about like what are like the high leverage decisions where we should be spending a lot of time and care in getting it right, because getting it right can make for big downstream implications years from now. And I think that's tokenomics is one of those things where I think a lot of people kind of like think through it, but they probably should spend even more time modeling it out, right? And thinking through how each of the stakeholders at different time periods might be affected by these initial decisions. And, there are a lot of resources out there. And I think a lot of it's also dictated by founder philosophy, right? How much to give to the community, how much to give to the team. Are you trying to be a king, or are you trying to be like rich, right? There's that classic conundrum, right, on how much ownership you want versus having less ownership, but then splitting the pie, or making the pie bigger as you split amongst more people. How tokens unlock, when they unlock, who's holding them, that all factors. And so you should definitely think through that. I oftentimes tell people that it's quite important to leave enough for the community, right? But also leave enough for the treasury, because everyone thinks that their initial plan is going to be right. And guess what? Everyone's wrong. If there's one rule about entrepreneurship, it's that your plan is always wrong. And it's about having that grit and determination to persevere over the course of 5 years, 10 years. It's about having the ability to pivot, whether that's with your product or marketing strategy or your team, right? You may have to fire people and rehire people, right? And so these are all things that will affect the amount of tokens that you're giving out, and when you're giving them out, and what you need them for. And so it's important to not just assume your current plan is right. I think it's much more important to have a pretty good initial thesis, but then afford yourself that optionality, because you're probably going to be a more informed person 12 months from now, and certainly 5 years from now, right, from running the business.
Yeah. Either way, the situation will guarantee to have changed. Very unlikely it just goes exactly as planned. I'm so curious if there are any good references out there for this. I could picture a site where they show like almost like market research, where you say, okay, this type, because it's more or less a formula, right? You have an aspiration of what you want to do. You have an understanding of the pivoting you might go into, but even just plotting your course on the trajectory of the business model you have, you'd say, well, 90, if not, my rule of thumb, whenever making difficult legal or regulatory or structural decisions in startups is if 95% of people are doing it this way or more, just do it that way. That's like it's hard to become the minority, and then figure out where the unique thing is that you do in creating an incentive structure that works. Because most projects, almost by definition, are going to be the same incentive structure. They're all trying to build a Telegram group or a Discord group or Twitter following. Like a lot of the mechanics are the same. And the more I talk to people, the more I realize people have all different ways of figuring out how they structured the incentives for tokens and equity and everything else. So,
Yeah, I mean, there are a lot of resources out there. I don't know if the audience can see any links I post right now, but
well, I'll
here's
include
one
them.
Twitter. Yeah, here's one Twitter thread I bookmarked because it has so many links to different tokenomics resources. Not all of them are good. Some of them are, not that good, and some of them are pretty basic, but it is fairly comprehensive. I haven't made my way through the entire spreadsheet yet. There's a lot here, right? But
Yeah.
I thought it was interesting that, a lot of people who have been in the space have submitted different ideas to this thread, and this person aggregated it. And so this could be a resource for the community as they think about, I guess, both like if you're starting your own project and how to set up your tokenomics, or as a token purchaser, how you're thinking about the tokenomics of the projects that you're purchasing, whether they make sense, whether they're favorable, what are the things to watch out for. And so I think there's some great resources there.
Yeah, love it. I want to shift gears in a little bit and ask you about OUSD.
Yeah.
What do you view as the compelling and unique part of it? Because I'm seeing a lot of projects that offer APY, return on people's money that they put into the accounts. Is it specifically that it's in a wallet, or is there some differentiation with the flexibility of the money in there? Yeah.
There are a couple differentiators, right? So we deliberately do not try to differentiate on having the highest short-term APY, right? There are all these new farms that come up where you can get triple digits or sometimes, quadruple digits. But oftentimes those yields are very short-lived. And there are trade-offs in terms of security and safety. There are, DeFi protocols that get hacked all the time or were outright scams, right? And so we want to steer clear of that completely. Our target market today is not the super degened crypto person, right? It's really around stablecoin farmers, right? People that want really high yields, typically in USD denominated terms that are safe, secure, where they can deploy a lot of capital and kind of set and forget. And so there's actually a very large segment of people and institutions in this space, and we expect it to dramatically increase. When you compare the yields that are available in TradFi versus what's available in DeFi, the delta is astronomical. Now, obviously, you have to go apples to apples, and you can't compare, this, crazy, highly incentivized farm that no one's heard about to a very stable, TradFi yield instrument. But you can compare OUSD to that, right? Because OUSD has been audited, probably half a dozen times at this point. We actually learned a very hard lesson for full transparency. When we first launched the product, it was hacked, right? And we lost $7 million of AUM, which sucked. This was when the product was still in alpha. It was unaudited, terrible experience, lots of sleepless nights, lots of stress. But we learned from that, right? And we learned around how do you ensure that it's super secure, how do we prioritize making sure user funds are safe. And since then, we've built a protocol that has not been hacked, right? That has demonstrated that it can have hundreds of millions of dollars, generating very healthy yields. That's very safe. That's very secure. It's very easy, right? You don't have to think. And that's one of the things that I think we're going to be able to win on, especially when we're targeting some of these people that are migrating from TradFi to DeFi. A lot of these family offices or even companies in the space that are holding large balance sheets, whether they're wallets or corporate treasuries or idle capital sitting in these crypto venture funds. And certainly if you go further down the conservative spectrum for like pension funds or insurance funds, they want great, highly competitive yields without the risk, right? And without the emotional roller coaster and without the headache of having to constantly manage funds on a day-to-day basis. And so OUSD aims to solve all those problems by being a bit of like a set and forget way to involve yourself in DeFi while still generating like tons of return. And very importantly, not taking really any sort of pricing volatility risk, right? Because it's stable coins. And so you're not having to buy some like no name, highly volatile token, put it up in like a pool to earn more of those tokens. But if token price crashes, then like, um, you've lost a lot more than you've earned on that yield. That will never happen with OUSD. It will always go up in terms of the number of units that you have, and you should always be making money.
Dude, I can't believe that happened. That sounds like a crazy, tumultuous, difficult experience to be running a company and have 7 million just taken out one morning.
Yeah.
You sit here now perfectly calm and cool about it, but was that, I mean, were you like, we had in the crypto company I ran, we exited a year ago, but we had a couple hacks on the order of like tens of thousands, and but they were so stressful. I mean, it was like, that was by far the most stressful days of my entrepreneurial journey across every startup I've worked on. Did you take it in stride and just say, well, we just got to patch the holes and get audited and move on? Or was it actually really emotionally difficult?
When it first happened, it was actually like utter shock.
Yeah.
And like what happened, and we got woken up, and it's like there was a total loss of funds, and Josh and I were like, you're joking, right? No, you're not joking. Okay. And then the next thing that happened was just like,
how did you figure it out? Like, what was it? How did you get the news? Like, was it an engineer in your team?
So we were actually both in Asia at that point, and so we got woken up morning time there, pretty rudely actually, because someone else in the same apartment building woke us up because they had heard about it. For whatever reason, our team wasn't actually able to reach myself or Josh on the phone, but they managed to reach one of our investors who was staying in the same building, and he came down and woke us up, and we're like, okay, we got to get on this stuff. And then we had a war room open, and we were talking to our team. It was like, oh wow, like this is for real, right? This is not a drill. This is not April Fools. It's bad. And so, not gonna lie, it was an awful thing to go through, but we kind of just got into gear and started thinking about, all right, how do we execute, right? Let's notify all the exchanges, see if they can potentially help or at least freeze funds. How do we communicate to our users, right? This is a terrible thing to say, which is, hey, guess what? Your money's gone, right? But at the time, there were a lot of hacks in DeFi, and I felt like a lot of companies weren't taking responsibility, and they were just saying, well, it's DeFi, stuff happens, right? Or, oh, you knew it was an alpha, you used it at your own risk, like we told you it wasn't audited, that's your fault, right?
When was this, 2017?
No. This was end of 2020, actually. Okay. So it was about a year and a half ago. But we were just taking the position like, no, like we're going to be better than what other people do about it. We're going to compensate our users. We're going to make sure that people don't lose money because of this. And there were a lot of people freaking out, right? Like you can, if you lose 6 figures, 7 figures one morning, that sucks, right? And there were team members that lost money too, because we were using our own product. So that was a pretty awful moment, but we kind of just powered through it. Had basically 2 sessions a day, first thing in the morning, last thing at night, doing handoffs between US team and Asia team, communicating with law enforcement, communicating with users, connecting with forensic analysts to try to debug this thing. Ultimately, we never found out who did it, but what we did do was we ensured that we did compensate our users, and actually they ended up making more money being hacked than they did because of the way we set up the compensation structure. And so everyone ended up being really happy about it eventually, like, oh, this is one of the best things that happened. And so we turned a very awful thing into actually a great thing for the company, right? We had a bunch of people that were very thankful for us, that, even said like, hey, like the way that you guys handle this, like makes me trust the company so much more. And we actually gained some new investors, and friends because of going through this turmoil and this hardship. And so I think it was one of those things that was absolutely dreadful to go through, but now it's kind of seen as a rite of passage, right? Like it helped us learn, helped us grow, become stronger. And the funny thing was like the actual pain of it didn't really like set in until after we kind of figured everything out. And then it was like, oh my God, what was the last 2 weeks all about? And then it was like craziness and mixed emotions and everything. But for the first period of time, it was all just about execution and how do we do right by our users.
Yeah, boy, I would imagine that it's nice to have already raised money. You know, some projects that get hacked don't have the luxury of being able to pay people out. Last thing you want to spend $7 million on, I'm sure, as you know, a founder of the company, but at least you can do that.
Yeah.
You know, was it a simple? Was it a?
Sure.
In hindsight, was it a relatively simple, like a human exploit, or was it a more complicated technical oversight and hack?
It was a fairly simple technical exploit. It was very ironic actually because our contracts were being smart contracts were being audited literally that week. And we had put a big warning like, hey, use at your own risk. This is an alpha, it hasn't been audited yet. Audits are coming. And our auditor actually found that exploit in the report, like literally like the day of or day before, but hadn't, you know, we had a meeting scheduled for later on in the week for them to give us a report on some of the issues. And then
that's a killer.
You know, yeah, it was like we missed the window by like 1 or 2 days, and it was unfortunate. But at this point, I kind of see it as like it was kind of just meant to be, and in a way, it also helped us. It's not obvious at the moment, right? But we saw who some of the leaders were at the company that really stood up and went above and beyond. We again tried to do our best to turn all the people that were affected into long-term believers by compensating them and actually overcompensating them, and it ended up working out quite well. But it's one of those things where when you're staring at it, you're like, "This is the worst possible thing to imagine." And then 6 months later, you're like, I would never say this is the best thing that ever happened, but it's like, okay, that happened. It was awful, but we're better for it. And in a way, I'm appreciative of the hardship.
Yeah. Sometimes I've heard, actually, I heard Jocko Willing describe war in that way, where you wouldn't wish it upon anybody, but having gone through it, you're grateful that you have. And it was a really important life experience.
Yeah.
Yeah. And it's hard to label things as good or bad. Obviously, in the moment, it feels obvious to say, this is terrible, this is bad, but we don't know. Like we really, I mean, this is true of our individual life and society at large, but it's impossible to label things as good or bad in the moment.
Yeah. And you never know what, like closing one door, like what doors will open when one door is closed, right? And life is kind of funny, right? There's, the butterfly effect, right? Like where something happens and it kind of causes you to change course, and then you change course and you do this and that. And then a couple of years down the line, you're like, oh, I went down this completely different path, right? But without that one thing happening, who knows, right? And you don't really know what's going to be better or for worse because you can't like A/B test this and live like 15 parallel lives and see which one is the best outcome. But going through it, at least you can kind of like connect the dots, like Steve Jobs says, and see like how some of the stuff kind of fits together over time, and how that's affected you as a person, as an entrepreneur, as a friend or family member. And so that is always a good thing to do, to just be like introspective and think, hey, what did I learn out of this, right? How did I grow?
Yeah, although maybe that's not the case. If I just watched the movie Everything Everywhere All at Once, and I don't know if have you seen that movie? It's
I have not.
It's this exact idea. It's like the fractalization of our life's experience, and they call it the multiverse, which is like all the different combinations of butterfly effects, and then it's all happening at once in one place in her head. So it's it's a trippy movie, definitely worth watching.
That's wild. We got to get the metaverse first, and then we can figure out the metaverse, right?
Yeah, exactly. Yeah, order of operations. I wanted to ask you one technical question on OUSD. Sure. When you're issuing returns, so the 14% APY that's listed, what's going on behind the scenes to be able to generate that return? Is there a borrowing component too, so people can borrow at 17%, you take a cut, then people can make returns of 14? Or are you pumping that into a bigger pool somewhere?
Yeah. So the way OUSD works is it's one-to-one backed by other, I would say like, blue chip stablecoins. So currently that's USDC, which is, redeemable one-to-one with the US dollar. There's DAI, the largest decentralized stablecoin on Ethereum. And then there's USDT, which is the largest stablecoin total out there, although there's, some controversy there. But the idea is like, you can go to the OUSD.com, go to the DApp, and you can convert your existing stablecoins into OUSD. And what that actually does is takes those three base stablecoins and puts it in the OUSD vault, right? And that vault then, through a series of other smart contracts, redeploys that capital to Convex or Aave or Compound. New strategies are being added over time. And through decentralized governance, the community can decide, what the capital allocations are, which strategies we should be using. And it's all centered around like what are safe, secure, and sustainable yields, right? But as those, as USDC, USDT, and DAI are being deployed to these other DeFi platforms and accruing yield, both in the term of potentially like LP trading fees or borrow lend fees, that's being like reaggregated by the vault, right? And on top of that, as we know in DeFi, there are oftentimes incentive tokens. So it could be Convex or Curve, or I guess like Compound is sunsetting their incentive program significantly, but those tokens can then also be harvested and turned into additional yield, right? And so then the OUSD smart contracts do the calculations, and this is all back, right? Again, the vault holds these stablecoins, but then is able to do the rebasing calculation multiple times a day and say, hey, you've earned additional yield of this much in the last few hours, right? And that's how we get the number to always go up. And that's the main objective of OUSD. Like you hold OUSD, number always goes up. You see, your yield change, multiple times a day. And it's a very like addicting product in the world because you're just making more money by holding it.
But is that, when you say it always goes up, you mean the balance in the account always goes up?
Yeah, that's right.
Right. And that would be true of any account where you have interest on the account in USD, right?
Yes. Yeah.
Right. So it's not.
But
Go ahead.
Well, if you're just holding USDC, right, and you're using USD to farm, right, what you're usually getting is like you're getting an LP token back that represents your share of the pool, right? And then you're not actually holding USDC. You can't like spend it and use it at the same and use it to farm at the same time. Does that make sense?
Yeah, I'm thinking of like Celsius and Nexo, where you put USDT or some stablecoin inside their wallet, and then it's just sending you daily deposits.
Yeah. So one big difference is those are like centralized providers, right? OUSD is, you can hold it in your own MetaMask or your Ledger or Trezor or your multi-sig. It's self-custodied. It's also available on some centralized exchanges, but you don't need to actually use a Celsius, right? It's like you can just purchase this on Curve, do a swap into OUSD, hold it in your own wallet, and it's just earning that yield without any centralized custodian.
Got it. And that's pretty uncommon. Like, how many other projects do that, where it's decentralized wallet returning yield on stablecoin?
I can't really think of that many others, to be honest. It's definitely like a new innovation that we've done. Now, there's all different types of stablecoin farming. There's like thousands of different permutations, but our approach is quite novel. I believe there may be like one or two new entrants trying to do this on other chains, but it's definitely a unique technical implementation that we have.
Yeah. Do you think in hindsight, or not in hindsight, but today, does it make sense to offer a guarantee? So say hypothetically, rewind the clock a few years and you said, hey, if we ever get hacked, we're going to reimburse you, so don't worry about it. I would imagine your user adoption, significantly goes up because people view that as additional trust. That's what ended up happening. You guys did end up giving the money back. and then some. Is that what you're currently doing, or would you do that now, even though it's a decentralized wallet, given that you put so much into auditing and feel secure about it?
Yeah, so what we're leading on now is number one, that we've actually done a great job with the audits and security, and thankfully, I think the results speak for themselves. But also, we have partnered with a number of decentralized coverage providers, right? And so this way, people can take out essentially insurance, right? And so something happens, and they're able to claim insurance on, let's say, an exploit or something like that. And I think there are going to be more and more of these integrations coming forward soon. But I think we're going to get out of the business ourselves of offering that insurance, and instead work with the people that are actually specializing in decentralized coverage.
Yeah, yeah. And what do you know approximately what the insurance rate would be? So if you have if you're earning 10% yield, is 2% or 1%, or is that even the right way to think about insurance as a percentage of what you're making?
I don't have the latest numbers off my head, but yeah, I mean, you have to, allocate
Some percentage,
capital
yeah.
for that coverage, and so you would be able to calculate, how much of that yield you're effectively giving up, even though it's not like directly coming out of the yield to get insurance, right?
Mm-hmm.
But yeah, it will cut down into your returns, but it also depends on what, like different coverage systems have different parameters. So it might be like, hey, I want coverage for a week, or I want coverage for a year, right? And that's going to affect the cost of that coverage.
Yeah, it makes sense. It seems like a more straightforward model than the story.xyz. Is that right? Do you feel like when you describe story to me, I'm like, oh my God, there's so many different ways you could take this, all the different verticals for artists and people creating NFTs. Now we're talking about a virtual space and creating NFTs, and there's all different applicability and products you build. Whereas this is like, hey, you got money? We want more money? Put it in this wallet. It's relatively straightforward. Is that internally, is there I can't imagine there's 50-50 distribution of talent on these two projects. Does what I'm saying make sense with how you're thinking about the trajectory of these?
Yeah, we have talked about this in the sense that we think that like OUSD has a more tightly constrained product roadmap and acquisition roadmap, and that it's all about execution, right? Can we deliver on what we want to do? And that's not to say that the execution is necessarily straightforward and easy, but there is a plan, right? And there's like an understanding of how to kind of like keep marching to get that graph to go up that way. On the story side, I think the idea space is newer, and it's a little bit more fluid and open. And so there are more directions that we can take it. And the pros and cons of this are like the unknown unknowns, right? We don't necessarily know what's going to happen in the market in the next couple of years, what's going to be hot versus not. We do know that NFTs are going mainstream, and more people are Googling for NFTs than even the word crypto. And I think more and more that new people are going to be introduced to blockchain technology and cryptocurrencies because of NFTs, right? And so there's both our markets, DeFi and NFTs, are absolutely gargantuan and should be multi-trillion-dollar markets at some point in time. But they are going to be like slightly different paths as we kind of follow the execution path. And in the case of the NFTs, like a bit of like the idea maze, right? And I think the feature set will necessarily need to be a little bit more broad on the NFT side versus the OUSD side.
Yeah, that makes a lot of sense. I mean, just common sense is we generally have a pretty good idea about what people want with money and what they want with wallets and storing it. The NFTs is the Wild West, where it's like, hey, what does it mean to have an NFT for an art piece? What's your take on the landscape of? I guess the simple question would be: are we in a frothy market where there's too many NFTs being created, and the underlying incentive for people creating NFTs is to make money, as opposed to offering real value of the consumption of art or other products through those? Do you get that sense? Do you have an idea as to where we are? in the NFT creation world?
Yeah. So here's kind of what I say about NFTs, and actually I would say probably cryptocurrencies in general, right? Which is I always say that in the short term,
Right.
we're overvalued. In the long term, we're undervalued.
And do you mean
so
that
at
as
any
of
given
today?
point,
Do you think of that as like April, 2022? Because that certainly wouldn't have been true at 2018 in the crypto winter. It'd feel like, well, the short term is undervalued and the long term is overvalued.
yeah, sure. I would say probably for the last like year or so, with kind of like the new resurgence of the cycle, and price appreciation, where Bitcoin's up 4 to 5x where it was 18 months ago. Ethereum is even more dramatic, and other layer ones are up like 100x where they were 18 months ago, right? So I would say short term overvalue, but long term undervalue. What I mean by that is like it's really easy to say like, okay, like stuff is expensive, and that's absolutely true, right? And so if you're a day trader, now may not be the best time to be sizing up or being risk on. But if you're valuing, all of the space, and also taking like a 10-year time horizon, it's like, no, this is like going to revolutionize the entirety of the internet, right? And the Web 2 internet is this monstrous, beast that has touched every corner of life, from our communications, our working, from e-commerce, from telemedicine, from research, and from figuring out how to like get information through Google, through social networks. Like these are industries that didn't exist in Web 1 that are absolutely massive now, right? And we're going to see the same thing happen with Web 3, and we're going to see I think multiple segments within Web 3 where this occurs, including NFTs, including DeFi, including stuff that we don't know about, including infrastructure plays. And so it's going to be massive. Not all the winners today will be winners 10 years from now. And many frothy, speculative projects today will probably go to zero, or at least have severe discounts and valuations. But the overall market is going to be much bigger. And the people that do really well today are going to be like the Web 3 versions of Alphabet and Meta tomorrow, right? But hopefully with better incentive structures, so that the users win a lot more, better decentralization and distribution, and more fair value capture for all the ecosystem participants. But there are going to be these very large projects that touch hundreds of millions and billions of users over time, right? And so to that extent, I would say the entire industry is undervalued today. One example that I like to use for NFTs is that it's almost like HTML in the first wave of the internet. HTML came out, and in the beginning, the websites were pretty crappy, right? Like CSS was like inline CSS, and you had people with like giant red buttons and like flashing red text. And to the common person, it's like, why would I mess around with this? It seems useless. Oh, you're saying you want to like put content, but I can read a newspaper, right? Oh, like, why would I want to buy anything? That's stupid. I want to go to the store and see what the materials like for this shirt, right? I don't need email, right? I can write my friends a letter or call them on the phone. And these things were rightly seen as like facetious and not stuff that was easy to use, and the learning curve was high. But guess what? Like, because of HTML and other protocols, right? Like TCP/IP, and the way that the internet was built, right, on these fundamental technologies at the various layers of the stack, within a couple of years, there was e-commerce. Right?
Yeah.
Amazon was selling books. A few years later, it's like, there's social networking. Years later, there's mobile. And so like, there's all these sub-industries that seemed tiny at the time: blogging, social networking, e-commerce, like that today, everyone is plugged in, everyone is deep there, right? And so NFTs are a fundamental building block, just like HTML. Right now, there's a lot of speculative behavior, a lot of crappy art, or even projects that are doing rug pulls, people that can't deliver on the roadmaps. And I think there will be a lot of projects that fail, just like there are many early web pages that are created that no one uses right now, right, that are out of date. But there are going to be these new veins of innovation that build upon NFTs, that have new utility, that unlock new ways of representing digital value on chain that I think are just going to massively change the world, right? And I think that's going to happen in gaming, for example, right? In-game items and currencies should be represented as NFTs or fungible tokens, creating more liquid markets, allowing people to transfer value between games. I think it's going to happen from a brand and content perspective. Bored Apes is probably the best example. Analogy that I use there is like Disney spent like 150 years. They created Mickey Mouse, Minnie Mouse, the characters. They did merchandise, they did a bunch of movies, they have theme parks, and they have this massive empire that's Disney now, but it's all top down, right? It's like everyone that was involved in this was working at Disney to serve the customers. What if you flip that model around and everyone that's in Bored Apes is also an advocate, and there are people building restaurants, creating DJ duos, doing derivative art, doing merchandise, building games, building like ways to bring your NFTs into these experiences without Yuga Labs having to do like the majority of work, right? And that's fascinating because it means that you can have an army of people building up that brand and that content. And so that's going to change the way that movies are made, that kids' toys are made, that, you know, this IP is brought forward. And then you can see NFTs taking shape with digital items now, or sorry, physical items now, right? We're starting to see NFTs as representations of handbags and cars and things that exist in the physical world. And NFTs are used to tokenize them, and then you can then fractionalize those NFTs. So one day I think you will be buying, investing in real estate via NFTs, right? Or having your share of ownership in a business or of a highly sought after premium item through NFTs. And so these things are all going to happen. And they're already starting to happen, still nascent. So in a way, sometimes the valuations are high. And again, that's why I say they're overvalued and frothy. But when you map out how technology is adopted, it usually happens exponentially, right? And exponential stuff looks pretty lame, pretty lame. Then it hits an inflection point, and then it's like inevitable, right?
Yeah.
So we haven't reached that yet, but at some point we will.
Yeah.
And so that's what I'm looking forward to.
Yeah. Once it's just purely better than the alternative, because you have to see the vision for the better before it's better, like the old shitty website or the email that's super slow. But you see conceptually, hey, if we solve speed problem, security problem, the usability problem, like if you solve these problems, then all of a sudden it's way, way better. And people, not everyone sees that vision and the ability to solve those problems equally, hence kind of the user adoption curve and crossing the chasm into mainstream. I wonder about because when you get that, you know, your explanation there makes perfect sense, right? To summarize, I would say technology is difficult to see the long-term vision in the short term. So thus people undervalue it in the short term, and then it comes to fruition in the long term. There's also the case that in startups in particular, but also technology as a whole, there's a ton of offshoots that hit dead ends. And oftentimes there's big offshoots, like you'll see, you know, a lot of money going towards some vision of the way of the future, in particular, how people think that other people will want to behave or consume things. I think of Qwiki, which is the app that's like, people want to watch 6-minute videos while they take a shit. And so we're going to raise $1 billion and we're going to make content specifically for this. And then, oh, wait, people didn't want that. And I think I try to build the mental model, which in the case of NFTs and crypto is like, what's the cash value of what we're building? You know, there has to be, because we get really excited about the speculative value in the future. And unless that's rooted into something that you can, I don't like the word demonstrably, but it's like, it's really grounded in reality. I feel like the trap with NFTs is that you're valuing something that only has value if other people value it, which is kind of how money is. But NFTs is like that to the extreme, because you can't actually trade, you know, a Bored Ape for a bagel at a coffee shop. And so it's only what it's worth. And I think about what's the refinement of this mental model so that we don't all take a major misstep here and say, we're going to pour a ton of money into this with really the only ambition is to watch the money go up. Because I think of art in the physical form as being something that I can uniquely consume and get value from if I'm physically in front of it. And so if I'm purchasing a digital form of art and I can get equal value to you, Matt, and you're watching it on your screen and I'm watching it on my screen, yet I own it. What am I getting in addition to what you're getting to justify my owning of this. And yeah, I don't know if you have a thought on that, or what your reaction is.
Yeah, I do, right? And so I think art is the first place that NFTs like took hold, and it kind of makes sense in retrospect. Devin Finzer, CEO of OpenSea, actually said this too. He didn't really expect art to be the first vertical that took off, right? He expected like gaming, right? Stuff in the metaverse, right? These things that people are playing with in games, but because art is so like fundamental, and there isn't that necessary promised utility. In hindsight, it's obvious why it took off, right? You just have to have something that's beautiful and someone that wants digital ownership of it, and to be able to prove that they own it and that it's scarce, right? That's why I think we've seen a lot of the early stuff in art. But art is also the most difficult to value, to your point, because it's quite subjective, right? Like, why is this like POC piece worth so much? Why did the Beeple piece go for $69 million? Like, well, because one person was willing to buy it at that price, right? But art is its own thing. I think NFTs will continue to do really well on art. But I think what you're talking to then is like, what are the other non-art ways that NFTs can deliver value and or utility, and how does that map to human behaviors that we're already doing outside of NFTs that are monetizable, right? And so here are a couple things that come to mind. So people are using Patreon today, right? It's a multi-billion-dollar company where fans can interact with creators through subscriptions to get private access to content or experiences, whether that's like a Zoom call, or maybe it's like early access to a song or video, et cetera, right? And Patreon has done an amazing job of allowing the super fans to self-select into a group of people that are willing to pay for this access versus the normal fan that might just be watching a YouTube video or listening to a Spotify track, right? And so it allows a super fan to pay more. NFTs can accomplish the same thing, right? And so if there's a celebrity or a sports team or an influencer that releases like these NFTs can double as access passes or membership passes for access to that creator. And so we're seeing a lot of this, right? We're seeing groups of people form kind of niche communities that require NFTs, or a particular let's say like a music producer that releases their NFTs and offers utility to those holders, whether that's backstage passes to concerts or meet and greets or merchandise, etc. And so there is like additional utility starting to emerge with those NFTs, right? NFTs for access. I'll touch again on gaming, right? So gaming is a hugely massive industry that's not going anywhere, right? And we've seen it through Web 1 gaming, Web 2 gaming. I remember playing like Diablo 2, and
yes,
then, other people were really big, like World of Warcraft people, and now we're talking about Web 3 gaming, right? And I think a lot of the same principles are still true. Like I remember playing Diablo 2 and spending a lot of time trading items. And that was actually more interesting to me at some point than actually playing the game, which was amassing this inventory of swords and shields and like wands and rings and stuff like that, right? And the amazing thing, for me at that time, I was like a kid in high school, but I saw on eBay that there was an active market for this, right? People were willing to pay cash for you to deliver these digital items. And at that point, people were like, why would you pay real money for a digital item? Well, guess what? People have been doing it for 2 decades now, right? And if you look at the crazy onslaught that happened with mobile gaming and social gaming, that was hugely value created for the gaming studios and publishers as well as the platforms, right? Facebook gaming and iOS and Google Play, like gaming is the majority of in-app revenue purchases for the Apple App Store, right? And so these behaviors have already existed for many years before NFTs. Now imagine that instead of buying like this item that's in this closed environment for this particular game, you're now buying items that are actually NFTs. And NFTs are built on open standards, they're interoperable, and you can then easily go sell this NFT after you're done with it. It's like a gaming NFT, and you're like, cool, I'm done playing the game. I want to like sell these items, but these items are more than art, right? They're digital items, yes, that someone else can take and bring it into the game, right? And what happens now when the same studio is like, well, these items are now interoperable into the 10 different games that we've released in the last 5 years, right? And so as a player, I now have higher stickiness because I can take some of those items and bring them to the next game, the next game, the next game. I don't have to start from scratch every single time, right? And so I think that's super, super interesting. Whenever markets become more liquid and have more participants, it also means, to your point, that there's more like speculation, right? But it also means there's more pricing efficiency and price discovery. And so I think that's going to happen with all these in-game items. And there is real utility for these items, right? They make your character stronger. They make you fly. They make you invisible. They make the difference between you spending, an hour in this experience versus 1,000 hours, right? And yes, like gaming is like mostly recreational. And I don't want like my future kids to be spending their entire lives, stuck in the metaverse playing games. But there's also a lot of good to games, right? There's educational games, right? There's ways that people bond online while playing games with people that have shared interests, right? And so there's a lot of utility there. So I think if we look at NFT as just art, it becomes only easy to understand to people that have collected art either in the digital world or in the physical world. But if you start thinking about NFTs as building blocks, even if the manifestations of those building blocks haven't been truly delivered yet, you think of like, okay, where does this building block fit into other industries? And that becomes really, really interesting. And those other industries have established business models, right? So slight tweaks, sometimes more extreme tweaks should yield really interesting monetization opportunities for people playing with NFTs.
Yeah, it's interesting. I interviewed a guy who's I interviewed two people, one of which was building his own game, and then he using the technology that he built to build an underlying protocol to transact NFTs throughout other games. And he said to me that like Activision and these other large gaming companies, they're really slow to introduce this. Like they could have introduced that a while ago, but their incentive is not to have people leave their platform. And it's kind of complex to like bring a tool in or a gun in from another game. And like they have a closed walled garden, very fast, secure database. So it's like, I don't think it'll be them. I think it'll be like new up and coming games that then have an underlying protocol that can trade.
I agree. And I think one of the interesting things is like those new games can borrow IP, right? Like we're seeing people build games around Bored Apes and Meebits and Cool Cats and whatever. Some of them haven't been delivered yet, but at least they're like, early screenshots or demos where this is happening. It's like, that's kind of cool, right? Like anyone can, assuming the NFT gives commercial licensing rights to the owners, anyone can bring in their NFT to certain games. That's really cool, right? That interoperability is already starting to happen. And it may not be the Activision that does it, right? But it's all this new IP, like the Azukis, right? Or the Clone X. These are characters that are kind of have universes, I wouldn't say built around them by the creators that have been like almost forecasted, right? But then other people can help build the universes through games, through merchandise, through comics, through TV shows, film, etc. So that art, that IP is also a building block that can be used for stuff that is already monetizable and highly used in the traditional world.
Yeah. I dig it, man. I hope to have you back on one day and we'll talk in retrospect a couple of years from now and see how our predictions paired out. But either way, Matt, really enjoyed getting to know you more. Are you active on social media? Do you write on Twitter and Medium or anywhere else that you want to throw out there?
I'm at Twitter. Just Matthew Liu on Twitter. I can drop a link here. I'm also on Telegram. There I'm Matthew C. Liu. Love talking to people in the space. Love advising and investing in new entrepreneurs and being helpful where I can, giving back. Everyone should feel free to send me a message, follow me, and happy to connect.
Sweet, man. And the site is originprotocol.com and story.xyz and OUSD.com. OUSD, that's a great domain.
Yeah.
4-letter domain. Bam.
Yeah.
Can't buy those anymore. All right, my man. Great meeting you and wish you the best of luck. Keep crushing it.
Thank you so much.
See you, buddy.
Appreciate it.